Okay, good morning, everyone, and welcome to PKF's Autumn Webinar Series. We're running with our second episode this morning. For those of you that joined us last week, we're delighted that so many joined and stayed with us for the duration of the webinar. This morning, we have two topics, one in relation to the budget that was held during the week, and the second one in relation to accounting policies and the effects that COVID will have on those. Our speakers this morning from the tax side will be Shane O'Donovan, who will be talking first in relation to the budget and the business aspects of the supports announced in the budget. What we had this morning or during the week on the budget was the biggest expansionary budget in the history of the state, with the government going to run substantial deficits in both 2020 and 2021. What will this lead to, and what are the effects of it? Funny enough, from a budget perspective and from a taxation perspective, it was had the least taxation policy ever in a budget. So the finance bill will be very short with very few changes in it, but it did have significant spending in a lot of areas. And I'll hand you over to Shane now to discuss the business aspects of the budget.
Thank you, Donal, and good morning, everyone. As Donal said, I'm going to go through the business aspects of the budget, mainly focusing on the COVID-19 stimulus packages that have been introduced. And Denise, could you just move the next slide on? I don't seem to be able to control it. Okay, so the budget is framed on two key assumptions. Those assumptions are that there's no vaccine found for COVID-19 in 2021, and that we have a disorderly exit from, or the UK has a disorderly exit from the EU. I think at the start it's worth just taking a step back and looking at where we are in terms of COVID-19 and the effects that it's having on the budget deficit. As Donal said, this is the largest expansionary budget in the history of the state at 17.7 billion. The tax measures included in that come to about 230 million, and that is largely represented in the VAT reduction for the tourism industry. If you look at the deficit that we're due to run for 2020 and 2021, they roughly come to approximately 20 billion per year. And for some context, that equates to, or is equivalent to, a deficit in 2010 of 48 billion. So our entire pandemic won't have cost us the equivalent of 1 year of the financial crisis. Which is a pretty stark figure if you think about it. So moving on to the stimulus packages that have been introduced, we have now had 3 COVID-19 stimulus packages. The key, or the cornerstone of the government's approach has been to protect jobs, focus on job retention, and support income for low and middle earning individuals. So they have done that principally by the TWSS and EWSS that's in place now. They came in, the TWSS originally came in March, ran to the end of August, and has now been replaced by the EWSS. We'll talk about those later on in the slides. In July, we also had the July stimulus, which brought in restart grants and debt warehousing. And now in the budget, we have had an extension of the EWSS scheme, and we have the introduction of a new scheme, which is the CORSS, which is a new acronym for if we didn't have enough this year already. So looking at the types of reliefs and schemes that are available at the moment, as you said, we have the TWSS, the EWSS. We have debt warehousing, which is vital for businesses now, and we have the new CRSS scheme. So we'll talk about those on the next slides. Looking at the restart grants, the restart grants are between 4 and 25,000 euro. They are capped at the level of 2019 rates. We have found from dealing with the local authorities and dealing with clients that the authorities have been very commercial and practical in terms of refunds and have been very fast to process those refunds. So we would recommend that any clients who haven't already claimed those restarts grants look at them, actively look at them. And there was a figure out from some of the councils saying that approximately 30% of businesses that are eligible haven't claimed those grants yet. So that's something that businesses need to focus on. There's also an extension of the rates holiday. So the rates holiday was introduced in March. It was due to run out on the 30th of September, but has been extended for three months up to the end of the year. Hopefully, there we will see an extension of that into next year as well, as we get further or closer to the year end. Then the main budget announcement was the reduction in VAT from 13.5% to 9%. I think Owen will talk about that in some more detail later on in the presentation. And then we also had the main VAT rate reduced from the 1st of September from 23% to 21%. I think the last time we had that VAT reduction, it lasted for a number of years. So hopefully that will be an ongoing reduction, and will benefit consumers going forward. Looking at the two main reliefs that have been introduced, the TWSS has now expired. It was an absolute headache for anyone that was involved in payroll or tax advisors for the first probably 6 weeks of the pandemic. So I think on one side we're thankful that the scheme has ended. We have been dealing with a lot of compliance reviews now. There's now been 2 rounds. The first round of compliance reviews was in July. The second round has been undertaken in the last number of weeks. So some clients may have seen a number of queries come out. We have found the revenue have been, again, practical in dealing with this, and provided you can show the 25% reduction, and you can show that in your figures, then they really have been very accepting that the business is qualified for the scheme. The TWSS was replaced with the EWSS scheme. That scheme was originally due to expire on the 31st of March. In the minister's speech, he has extended that until the end of next year. At present, we are waiting for details on how that will run post the 31st of March. He did say that there will be some targeted changes to it, so I would expect that there will be a tapering off of the scheme as we progress through next year. We have up on the screen there, we have some of the main conditions and rates that apply to it. I think at this stage people are probably familiar with how the scheme works. It is a lot more straightforward than the TWSS scheme that we had earlier on in the year, which is helpful and thankful for employers and employees as well, because there is no individual tax liabilities accruing up on the EWSS scheme. And just for some context, the entire cost of the TWSS came to approximately 2.9 billion. The estimated cost of the EWSS up to the 31st of March is approximately 2.4 billion. So I would imagine with the extension that we will see the cost of that scheme rise significantly. Moving on to debt warehousing, the debt warehousing is structured in 2 ways. It applies to COVID-19 debt, which is PAYE, and VAT, which has been accrued or liabilities that have arisen during the pandemic, and then also applies to a period of 2 months after businesses reopen. The second side of that is that you can also avail of non-COVID debt. You can also avail of the 3% interest rate going forward on payments. That includes corporation tax liabilities. In the budget, the debt warehousing was also extended to include self-assessed income taxpayers, there is some confusion at the moment as to how that will apply. The budget, or the Revenue Commissioner's leaflet on it afterwards stated that there was a requirement to have a 25% reduction in income. So we aren't exactly sure whether that applies to, say, individuals who are just self-employed and sole traders, or whether individuals with rental properties will be able to avail of it as well. So we are waiting on further details as to how that will be applied. The new scheme is the CRSS. It applies from budget day. It applies from budget day until the 31st of March. Initially, it applies to accommodation, food, arts, recreational, and entertainment sectors. In order to claim it, you need to be at level 3 restrictions. What they have said is that as restrictions increase, and if people move up to level 4, which the border counties are obviously doing from midnight, that other businesses, including retail, will be included in that. At present, we are waiting for further details to come out in relation to how the scheme will operate, and how additional businesses can be included in that. The way the scheme works is that it's a cash-based payment, so it's very similar to the TWSS in that you submit a claim and you will receive a refund within 2 to 3 working days. It is an advanced credit on trading expenses is how they have structured it. It is subject to a weekly maximum cap of €5,000, and that cap is calculated based on 10% of the first million and 5% of any excess turnover. So, and then that turnover period is included for the corresponding period for 2019. So, for example, businesses that are looking at claiming this now will be comparing their corresponding period in 2019 to this year, or to the period that they are claiming. In order to qualify, they will have to have turnover of less than 20% compared to that corresponding period. The estimated cost of the scheme on a weekly basis is €40 million, and that is on the basis that all counties would be in level 3 or higher restrictions. So it will be a significant cost, particularly as restrictions increase at the moment. I think with that, I'll hand back to Donald to do the next poll.
That's great. Thank you, Shane. Some interesting details there in relation to the budget. I think, the level of the deficit that the government is proposing to run will show the amount of money that's going to be put into the economy in both this year and next year. But interestingly, the measures there for business, while they are significant, they wouldn't make up for the large amount of money that will be spent. Most of the money, as we know from the media, is going to be spent on housing, on roads, on hospitals, on infrastructure like that, and also on health and education, and in hiring more people. So that is going to create a lot of employment, presumably in the public sector and also in the construction industry. But I suppose what we need to be looking at from a business perspective is how many of those reliefs that Shane outlined can a business create, avail of going forward, and are needed to sustain for the next 12 months or the length of the COVID. So we just have a poll here to make sure everyone's awake and still with us. And I suppose the question that we're putting out to you this morning is, what do you feel was the most beneficial COVID-19 stimulus measure introduced? Was it the temporary wage subsidy scheme, which ran for the first few months up to the end of August? Is it the VAT reduction from 23 to 21% that will be running, is currently running, and indeed the VAT reduction from 13.5% to 9% for certain sectors? Is it going to be the debt warehousing, where you can look at your revenue debt and try to manage it in conjunction with the revenue? Shane outlined what was in the budget on that yesterday, and indeed Catherine outlined last week more detail on that as well. Or is it the restart grants and the rate waivers, where people can get a reduction in their rates and also get some grants for putting in COVID measures to restart their businesses? So if you'd like to vote on that, we get an indication of what your thinking on that is. Our next speaker, as we're waiting for the results of that poll to come in, is Owen Kenny. Owen is a tax manager with ourselves. He has been with us for 6 years. He specializes in corporate tax. And Owen is going to talk to us this morning about the taxation measures in the budget, the key technical tax measures. And you can see the result of the poll there before we hand over to Owen. And the TWSS is there shown as the most significant measure. And I think that a lot of businesses availed of that. While it was complicated to get, it did support employment, and it allowed people to create a bit of certainty in a period of total uncertainty. So I'd certainly agree with you on that. We'll hand over now to Owen to talk about the technical tax measures included in the budget summary yesterday.
Thanks, Donald. Good morning, everyone, and thanks for joining us this morning. So, as Donald said, I'm just going to take everyone through the technical amendments that were made in the budget this week. So we're going to start with income tax. Sorry. I'm going to start with income tax. So the first one there is just change to the 2% USC rate band. So it's increased by €203. And this really is to ensure that full-time workers on the minimum wage remain outside the higher USC rates. Otherwise, there's been no changes to personal tax rates or bands. So that means that the marginal rates of tax for a person earning between 35,000 and 70,000 remains at 48.5%. For employees earning over 70,000, it remains at 52%. And for self-employed people earning over 100,000, the marginal rate remains at 55%. The next change there is just a 4% increase in the weekly threshold for employers' PRSI. Again, this is linked to individuals on the minimum wage, and it ensures that the lower rate of employer PRSI, 8.8%, continues to apply. The next change is an increase in the earned income tax credit for self-employed people. So this increases the current rate to 1,650, and now that's equal to the employee tax credit. The next change there is in relation to a dependent relative tax credit. So that's increased by €175 from 2021. So that'll bring the total up to €245 for 2021. Next then is in relation to remote working. So the minister outlined that there's an interdepartmental government group set up to deliver a strategy for remote working. And he outlined that currently the supports available for remote working are where an employer makes a contribution to an employee, they can pay €3.20 per day with no BIK arising. Where an employer does not make a contribution to the employee can claim deduction for light and heat used as part of remote working. And new for 2020, Revenue have confirmed that broadband may also be included in that claim. Revenue guidance is to be issued on this point, so there's nothing issued at the moment. And the last change there is just in relation to seagoing naval personnel. I don't know if there's anyone here that this will relate to, but for 2020, it's been extended for 2021, and it's been increased by €230 to €1,500. Next, then I'm just going to look at the corporation tax changes. So again, in the minister's budget speech, he reaffirmed Ireland's commitment to the 12.5% corporation tax rate. He did advise that the updated roadmap for the corporation tax rate is going to be published, and it's to reflect the action taken to date on corporation tax reform in Ireland. Next, the finance bill is to introduce the interest limitation and anti-reverse hybrid rules. These are coming into Irish tax legislation based on the EU Anti-Tax Avoidance Directive, the ATAD, and they're to be effective from 2021. Again, the rules will be published in the finance bill, which is due to be published next week. Next, then there's a change made to certain intangible assets. So just this change is effective from budget day. So for intangible assets which were acquired prior to budget day, there was no balance in charge arising where the intangible asset was held for more than 5 years. But any intangible assets acquired after budget day, they will come within the scope of a balance in charge on their disposal. So it seems it will affect onshoring of IP and intangible assets going forward. Next, we have a technical amendment to the exit tax rules. So this relates to the charge of interest on installment payments on exit tax. Next, we have the knowledge development box, which has been extended to 31st of December 2022. So this applies a reduced corporation tax rate of 6.25% on profits arising from qualifying R&D activities carried on in Ireland. Next amendment then is in relation to accelerated capital allowances for energy efficient equipment. So this has been extended, and this allows for a 100% capital allowance claim on energy efficient equipment. So it allows 100% of the expenditure to be claimed against taxable profits in year one of expenditure. And the last one then on corporation tax is the additional 5% of qualifying expenditure for film tax credit. So this has been extended for a further year to the 31st of December 2021. So next we have indirect taxes. So as Shane mentioned earlier, the 13.5% rate will reduce to 9% for tourism and hospitality sector. It's effective from the 1st of November until the end of next year. Next, we have the increase in the carbon tax. So the carbon tax is increased by €7.50 per tonne from budget night in respect to auto fuels, and the increase will be effective for all other fuels from the 1st of May 2021. The finance bill includes legislation to increase the carbon tax on a phased basis and to bring it up to €100 per tonne by 2030. So that means there'll be an increase of €7.50 per tonne each year and an increase of €6.50 in 2030 to bring it up to €100. Next, then there's going to be new VRT and annual motor tax rates to be introduced from 2021, and this to ensure that vehicles with the higher levels of CO2 emissions are taxed accordingly. Also, the VRT reliefs that apply at the moment for plug-in hybrid electric vehicles and hybrid vehicles will expire at the end of 2020. Next amendment there is in relation to excise duty on a pack of cigarettes. So that's increased by 50 cents from budget night. And lastly, then we have the flat rate farmer edition. So that's to increase from 5.6% or 5.4% to 5.6% for 2021. Next then is on to capital gains tax. So in the budget speech, the Minister advised of a change to the revised entrepreneur relief. So this is one of the main personal CGT reliefs available at the moment. This relief applies to qualifying individuals on the sale of qualifying business assets or shares, provided the individual holds 5% of the ordinary share capital of the company. So the relief provides a reduction in CGT rate from 33% to 10% on the first 1 million of sales proceeds. So previously, where shares are being sold, the individual is required to hold the shares for a period of 3 years out of the last 5 years immediately prior to the disposal. The amendment now removes the 5-year requirement, and the individual will qualify for the relief if they've held the shares for any continuous 3-year period. So this is a welcome change, and it seems to broaden the relief and potentially allows individuals whose shareholdings have been diluted maybe in recent years due to taking on investors. They will now qualify for the relief. The effect of the change is from the 1st of January 2021, and the requirement for the individual to have worked in the business for 3 years out of the last 5 years immediately before the disposal continues to apply. So this change won't benefit passive investors. Next, there was a technical amendment in relation to counteract an avoidance issue which arose in relation to foreign currency. So foreign currency is treated as an asset for capital gains tax purposes. So where foreign currency was moved between bank accounts, it could have created a CGT loss. So there is to be anti-avoidance legislation brought in to counteract this practice. Okay. And lastly, then we're just on some changes in relation to property. So the Help to Buy scheme was enhanced in the July stimulus package, which increased the rate from 5% or 20,000 to 10% or 30,000 for first-time buyers. So this relief is extended, and it was due to expire on the 31st December 2020, but it's the enhanced relief is extended now until the end of 2021. Next, the stamp duty on residential development refund scheme. This has been extended to include construction works commenced by the 31st of December 2022. This allows for refund of stamp duty for residential development on non-residential land. And in addition, the time allowed to complete from commencement to completion of a qualifying project has been extended by 6 months, from 24 months to 30 months. Next amendment there is in relation to stamp duty consanguinity relief. So it's available on agricultural property transfers between certain family members. This has been extended to 31st of December 2023. So this relief reduced stamp duty from 7.5% to 1% on land transfers between family members. It was due to expire at the end of 2020 and is now extended to 2023. And lastly, in relation to farm consolidation relief, the 1% stamp duty rate has been extended to the 31st of December 2022. So this relief applies to consolidation of farm holdings by way of linked sales and purchases of land. So the 1% applies to the excess value of the land acquired over the land so being disposed of, where the acquisition and disposal are completed within a 24-month period. And again, the relief has been extended to the 31st of December 2022. And that's everything on those.
That's great. Thank you very much for that, Owen. And just to remind our audience that we will have questions at the end of the session. So if people want to submit questions, we'll ask our speakers to comment on them at the end. I suppose very interesting there on the budget. Not a lot of changes on it. Obviously, the VAT change is significant for the hospitality industry, and some significant changes towards a green economy, which we can expect more of in the years to come. Some other changes there that I would comment on is one was the technical change there resulting from the EU and the OECD planning, which is one that we're going to see more of in the years to come. And this is where tax has been aligned more internationally, and it will have an effect on the Irish economy going forward because the multinationals will have to pay tax in different jurisdictions. At the moment, Ireland is benefiting significantly from multinationals paying tax here. And that those changes, while it's a small change this year, while we're coming more in line with the OECD rules and regulations, that will affect the amount of tax being paid in Ireland by multinationals. And the other change that I comment on there is the one, while it's a small change on entrepreneurial relief, it is a significant one to support it, I think, because in the UK, which this relief first came from in the last budget, the relief was reduced, and there was a worry that it would be reduced in Ireland. And this is a significant relief for people retiring or selling parts of their businesses where they can avail of a 10% rate for of capital gains tax on the first million of their gain. So it's good to see the government supporting that particular relief in the budget. And just to have another quick poll, I suppose we can see that the budget is going to cost a lot of money in the deficit. This is going to be financed by borrowings in the short term, but the annual cost that the minister said of the measures would be in the region of about 3.6 billion in additional expenditure. And this expenditure, together with what is likely to be at least $1 billion in drop in corporation tax from multinationals due to OECD measures over the coming years, means that in the next few years there'll be an increased requirement to fund the economy of at least 5 billion. I suppose the question that we're asking you is, how do you think that this current budget spending will be financed in the future? Will it be done by increased borrowing or funded from the EU, some maybe EU handouts? Will the government look to increase income tax rates? Top rates are at 52%. Can they put them higher? Or will they squeeze the middle class even more? Will they increase the corporation tax rates if OECD are putting pressure on reducing the multinationals take? Will they look at the 12.5% rate and increase that? Will they preempt a left-wing takeover in a future government and introduce a wealth tax? Or will they reduce the business tax reliefs that are significant there at the moment for inheritance tax and tax planning structures? So maybe if you have a think about that, and I'll have a quick chat about our next speakers while we're waiting for the results of that one to come in. Our next speakers will be Dave McGarry, Audit Partner, and Keith Doyle, Audit Director. And they're going to talk to us this morning about the challenges that they will have in completing annual accounts next year. I suppose COVID has provided many challenges for businesses, and these challenges will be reflected in the accounts and annual reports that have to be completed for businesses at the end of the year. And what the two guys are going to talk to us is what do we need to consider now in relation to those? What effects will they have on the annual accounts? This could have significant effects for raising finance in the future, and indeed for getting investors in the future. They could also have effects on the director's duties in relation to annual reports and indeed running of the companies. The two guys will talk about that in a second. And just in connection with the poll there, I suppose people are pretty confident that corporation tax or wealth tax won't change. They think it'll be financed by increased borrowing. Well, that would be great for my age group, because then the younger age group will have to pay for it in the future. I suppose what we would say just in relation to that, the budget this year didn't introduce a lot of changes and things, but we would see that it'd be very important for people would look at their structures, make sure that they were structured everything in the most tax efficient way possible, because there could be significant changes next year. And indeed, those significant reliefs, if they were changed or reduced, they would have a serious effect on people's planning. So they should continue to look at them, make sure they're in the best structure possible to pay as little tax as possible, because one of the issues there will be with tax warehousing and people deferring debt, there will likely businesses and individuals will have to pay potentially 2 years tax over a 3-year period. So that would be a very difficult cash flow situation. So without further ado, I'll hand you over to Dave McGarry, who's going to talk to us through the key accounting and financial considerations for companies.
Thank you, Donald, and good morning, everyone. Keith and I are delighted to see you all online with us this morning, and thanks very much for your company. We've put together an ambitious agenda of topics in this session, has to be said, but we've picked them deliberately as they're particularly relevant as we approach the end of the year for most companies, and they'll hopefully give you some food for thought and some planning opportunities that can be a benefit to you now, and you can start to really plan ahead as to what those 2020 year ends might look like. Also, just to add, with the recorded presentation, all the slides will be sent to you straight after today's session, so please don't worry if you miss anything. And finally, just to say that, look, we're available to you at any stage after the webinar today to discuss any of the topics in more detail, on any questions or queries that you might have, and you'll find our contact details at the end of the deck. So please do get in touch if we can assist in any way. So we're going to start off in 2 parts. I'm going to take the first part there in relation to the going concern, asset impairments, post-balance sheet events, and some other key planning considerations. And then I'll be joined by Keith, who's going to give us some key topics and key pointers really in relation to financial statements and how everything that's happened this year is likely to manifest itself in financial statements for year end 2020. So Before we kind of kick into the first topic there, which is in relation to going concern, we have a short, quick poll, yes or no answer. If we could just load it up there on the screen, and it's really just to get your initial thoughts on the whole topic and area of going concern. I think that might be the second poll that's come up there for a little later on. There you go. That's come up nice. So hopefully you can all see that. So the question really that we want your view on is, do you believe there's sufficient awareness of, the company law obligations imposed on company directors as it relates to going concern? So we'll just give people a few seconds just to respond to that one. Okay, no, 69%. Okay, well, that's great, because we're hopefully going to provide a little bit of info around that topic now and a little bit of enlightenment on it. So what are the obligations that are imposed on company directors under company law? I guess the first thing to say is that they're quite onerous. And really the key thing here is that directors have to be really comfortably able to assess that the business has the ability to continue for at least 1 year, what I've called ahead of present time. So the key metric here is to always be thinking 12 months from where we are now. And that's important, because if you don't have that window available to you, then it suggests maybe that perhaps the business may not have a future, and you may have to consider other alternatives. But so the key thing there is really that directors need to be able to look 12 months ahead. And I suppose, if there's a situation where a company enters into an insolvent liquidation, the question will always be asked, as to how did the directors respond when it became clear that the company was in financial difficulty? And did they really consider and adequately assess and address going concern and act in the best interest of the company creditors? Now, unfortunately, if that's found not to be the case, the personal implication for directors can be quite stark, as you can see there from the slide. There are restrictions, potentially personal liability, worse yet, and potential criminal and civil liability where there was intent to defraud creditors of the company. So, and it's also really important to note that these apply both to executive and non-executive directors. So, company law doesn't distinguish between the two or discriminate between the two. So if you are a non-exec director on a board, this very much applies to you too. And so what we'll talk about now is, what is one of the key things or key protection mechanisms for directors to demonstrate that they performed their duties and functions in good faith and acted responsibly? And the answer really is to have a robust and evolving directors assessment of going concern in place to support the decisions that they've taken to date and will continue to take. So the question that we're often asked is, where do I start, and what should be included in the director's assessment of going concern? And while a lot of what we're going to talk about now isn't rocket science, sometimes, it's really just having a bit of structure. And so, like most things, you need to know where you currently are in terms of the business finances. So you need current management accounts of the business up to date, and any projection that we're going to prepare based on that, it has to have that accurate starting point. So, a planning point here is, look, if your current systems can't provide you or don't provide you with the up-to-date information you need, then you really need to look at upgrading these immediately. And going back to our first webinar, my partner Tony Kelly talked about cloud accounting opportunities. So it might be worth revisiting that, and there might be some helpful information there. The second thing really is to try and understand and assess what are the principal risks and uncertainties that the business is facing right now. There'll be some very obvious ones and maybe some less obvious ones, but these are important to really kind of document and get down, because it's these things that are going to drive the key assumptions that will kind of drive into what our projections are going to look like. And then from that, it's a financial and cash flow forecast. So remember, we mentioned earlier that the key lookout period here is 1 year ahead of where we are currently. So at a minimum, we should be able to produce and include financial and cash flow projections and forecasts, not just at the profit and loss account level, but also into balance sheet and the actual cash flow forecast statement itself. And that needs to be capable, and the assessment needs to be capable of operating on a rolling basis, so that constantly we're always able to see where we're hopefully going to be 1 year from present. And then once we put those figures together, it's going to be based on assumptions. And in the current environment, those assumptions, are changing daily. And so our projections really need to build in an element of sensitivity analysis. So we need to be able to, easily see if a 10% reduction in revenue occurred from a projected levels, where would that leave us? And something similar with costs and materials and things like that. What's really important, obviously, is our borrowing facilities. So if we do have existing facilities with our bankers, we need a forecast that's able to identify really quickly where we might have a covenant breach. And we'll talk about covenant breaches a little later on. But obviously, the thing about the covenant breach is, it's vital that we spot it early and that we can engage with our lenders, before a potential breach occurs rather than afterwards. So again, important that our projections factor in, our covenant requirements. We should also really document where our contingency plans, can come into play. And so if we plans for cost reductions that we can make, when do these fall to be implemented? Should our results start to fall below where we expect them to be? And this would really also include an insolvency contingency plan. Should it become clearer that we may not be able to continue as a going concern, what are we going to do? What contacts are we going to have, and when are we going to make those decisions and have those discussions? And again, we'll talk a little later about this as well, but contingent liabilities. So these are kind of important to factor, because some decisions that we make may trigger additional costs that will accrue to us in the short term. So redundancy costs and property leases that become onerous are pretty good examples of this. And so having put together the director's assessment of going concern, the key thing is that, look, it has to be an evolving document. And we would always recommend that, this is the director's assessment of going concern is a key topic at all board meetings. And, those meetings should be held regularly, documented and minuted, to continue to review and update the director's assessment of going concern. And where necessary, if we determine that we need to take some legal or financial advice externally, that we document that we've considered that and we've done that, and what the results of those advices might have been. And then finally, look, the big thing is if we do feel we're going to have an issue with creditors, particularly lenders, but even with our suppliers, it's to engage and start to engage with them as early as possible, to maybe discuss or renegotiate existing terms. We published some articles on this, and there's a link to one there of our most recent article. So there's more information there. And really what I'd say in conclusion here is that a lot of what we've mentioned there, I suppose, can be a little bit unsettling. But it is really important to note that directors are still entitled to trade and draw credit, as long as they honestly believe that there's reasonable grounds that their business can continue as a going concern. And so the foregoing was really about, producing a director's going concern. It's a vital tool to demonstrate and validate that belief that the directors have, and at the same time providing protection in the event that, down the road, things unfortunately did not materialize as the directors had hoped, but that they've documented and demonstrated at all times that they acted in good faith. So that's, I suppose, a little bit really on the whole director's assessment of going concern, a key topic for where we are right now. And, I think, as I said at the bottom of the slide there, the previous slide, we're here to help. We can provide you with information, templates and advice in relation to, how you can prepare your director's assessment of going concern and keep them updated. So please do get in touch with us if we can help you in any way. So moving on to something that is related in part, is really the whole area of asset impairments. And this is going to be very topical for 2020 balance sheets. What we're going to try and do here is demystify what's always spoken about as an impairment review. So what is it? What assets does it affect? And what one might look like through a practical example. And then just to talk about other assets on our balance sheet, investment property, stocks, debtors, etc. How they need to be valued and what you need to be mindful of in terms of preparing financial statements as we go into year end. So generally speaking, the need to perform impairment assessments will apply to the following asset classes. So really, it's our fixed assets, our intangible assets, and some unlisted investments. Really, typically would be holdings in our subsidiary companies. And these are required where there's an indication that the asset itself might be impaired. So unfortunately, the current situation we have with COVID-19 is probably a checkbox there in terms of, most companies will have to consider asset impairments as they come towards 2020 year ends. But the basic principle here is that at a simple level, we cannot carry an asset in our balance sheet at more than its recoverable amount and more than we can demonstrate that it's worth. And we define recoverable amount as fair value, less the cost to sell, most often demonstrated by an external valuation, or we can adopt what's known as a value in use. So in simple terms, if we had a property and we had it valued and it was determined that that property was in excess of what we hold it in the balance sheet at, then there's no impairment. However, in certain instances and certain assets, it might not be possible or commercially practical to have assets externally valued. So then we're down into justifying their value by using a value in use calculation. Now, value in use is defined as the present value of future cash flows expected to be derived from an asset. Sounds simple, but unfortunately that definition isn't much use to us. So what we're going to try and do is a little example now, and here's what's important, and here's what we're going to look at in the context of that example. What we're seeking to do here is to compare the discounted future cash flows that we'll derive from an asset against its balance sheet value now. And from that, we can draw a conclusion as to whether the asset is indeed impaired or not. To do this, we require cash flow projections over the expected life of the asset, and we need to discount those at an appropriate rate. And for the purposes of value in use calculations, we're going to ignore debt and taxation. So those are kind of three starting points. And if we can move on, we picked an example that we hope is a little bit topical. So in 2020, in response to changing consumer behavior, a restaurant group has now established a company to specifically manage their online sales business. So as a result of that, we've invested significantly on the platform, as you can see there, and we presented below the first expected profit and loss account and balance sheet for 2020. So the things to note there, obviously you can see on the right-hand side, we've invested 750,000 in our website platform that's going to deliver us our new business channel. And equally on the left-hand side, we've incurred quite a considerable amount of actual costs in cost of sales, administrative expenses, and significant amortization of our intangible asset of the 750. So you can see there, really, we're going to incur significant losses in the startup phase. And moving on, so we've now decided that, look, we probably do need to do an impairment review. We cannot get the IP, the 750,000 investment that we've made, externally valued. So we're going to have to go with a value in use calculation. So on that basis, what we've done is we've put together the projections to 2025, and you can see them there below. So we might just take a little polling question at this point, based on what you see there. What's your initial take on whether the asset that we have, the website we've constructed, whether that needs to be impaired in our financial statements? So hopefully a straightforward yes or no. Okay. Oh, well, that's coming in, Keith. We might just move on. So overwhelming majority of people said yes. Okay. And that's perfectly natural given you see the figures there. So can you bring us back a little bit, Keith? Because we've given the answer before. We've gone through the cash flows. Perfect. So first of all, as we said at the start, look, this is an exercise about cash flows and not profits or losses. So what we'll do is we'll take our figures that we've shown you in the previous slides, and if you see at the bottom there, we're going to convert those to cash flow. So we're going to convert those to EBITDA. And really, in this case, we've taken a simple example. So what we've taken out there is the amortization charge, because it's a non-cash cost. And so if you see at the bottom there, we've converted our figures to EBITDA, which we now feel are meaningful cash flows. We have then applied a discount rate of 13%, which we regarded as appropriate given the risk profile of the business and the cost of finance that might be available to us. And we've taken those, and the last thing we've done is we've looked at a terminal value. Now, don't worry so much about the definition of that, but it's more taking our cash flows into perpetuity using an assumed or very low growth rate. And what we've come up with there is, having taken all of those into account, we have determined that we are going to generate cash flows in respect of our asset platform of 1267535. So having done all of that, we're still in a position. What does all that mean? Well, back to the original definition. Our future cash flows 1267535. We said at the start, remember, that we add back or we exclude debt financing from our cash flows. So we also do the same for looking at our carrying value. So we've gone back to our balance sheet that we had at December 2020. We've added back the debt, and we've now an adjusted net asset value. And in short term here, guys, what we're saying is that notwithstanding the significant losses expected in the first couple of years of operations, our value in use exceeds our carrying value. So in this particular scenario, our assets actually unimpaired, and we can justify carrying that 750,000 in our balance sheet at the end of 2020. So just, I suppose the overarching point there is to say that a well-considered set of financial projections are the cornerstone of not only a director's assessment of going concern, but they're also the key tool to effectively demonstrate that our assets are not impaired in situations where we have to go with a value in use calculation because an external valuation is not possible or practical. So a couple of other things to mention there. Subsidiary investments. What we'd say here is, these have to be carried in our balance sheet at cost less impairment. So the starting point would be to look at the net asset value of our subsidiary and compare it to our parent's investment in that subsidiary on its balance sheet. If the net asset value is less, then we need to consider a valuation or impairment review that we've done just now. If it's more, then we've no issue and we can conclude that we've no impairments there. Investment properties will be very topical this year, normally recorded at fair value in the balance sheet and calculated by an expert valuer. But it is possible for directors to appraise the value themselves, provided they can obtain suitable expertise. And so what we see a lot there is directors doing their valuation, their fair value assessments based on published data and rental yields and things like that that are published and available in the marketplace. So investment properties, fair valuing those can actually be not as difficult as you might think. Stocks, at a basic level, we carry it at the lower of cost versus our selling price less cost to complete. I think that's quite intuitive. But just to note, this does get quite complex where we're dealing with long-term contracts or maybe where we've got development lands involved, because obviously looking at future selling price less cost to complete is a more challenging exercise in those cases. Debtors and intercompany receivables, I've looped those together because we should consider them in the same way. So in the same way that we look at our debtors and apply a level of judgment as to whether we think we need to make provisions against them, our intercompany receivables from fellow group companies should be assessed in the same way. And then finally, just to consider that, if we have substantially, valuable assets on our balance sheet that we've currently carried at cost, there may be an opportunity to revalue those. And so it might be worth considering if we want to, if we've got substantial, say, property and equipment assets that we know if we had them externally valued means we could lift the fixed asset value in our balance sheet by a couple of million, could certainly be worth doing in terms of 2020 balance sheets to help support and bolster them. But also, directors should even consider disclosing. So albeit they may not go with a full revaluation approach, there can sometimes be no harm even putting a small disclosure in the accounts to say that notwithstanding that the company's asset portfolio is valued at cost, the directors, are confident that the fair value of these assets would be substantially in excess of the carrying amount, and even mentioning that. So we've covered quite a lot there in the director's assessments of going concern and impairment assessments, but we think these are going to be very, very important areas as we move towards 2020 financial year ends. The third big topic really here is on the whole area of post-balance sheet events. And we've got two classes of these. So we've non-adjusting. And so really what we're talking about here is these are conditions that didn't exist at the balance sheet date. So there's a few examples there, and we may be required to disclose them, but what we're saying is, they will not impact on our financial results if it's an event that happens or exists only after the balance sheet date. So that's the important thing to note there, but there may be disclosure requirements. So the most important ones for people are the adjusting post-balance sheet events. And this is really where we have, through the passage of time, additional information on conditions that existed at the balance sheet date. So a couple of small examples there. A debtor goes into liquidation. They owed us 100K at the balance sheet date and 250 when they go into liquidation post year end. So the right answer there was we should provide for the 100K at our balance sheet date and not the 250, which sometimes kind of, people wouldn't expect that to be the case. An investment property was valued at 2 million at year end for our financial statements, but before we've approved the accounts 6 months later, it's now only worth 1.5. Again, strictly speaking, we shouldn't book that impairment or that devaluation in our current year's financial statements. And again, sometimes that can be surprising to people. An important one is breach of bank loan covenants. So if you have term debt, you'll normally have seen that presented between short-term creditors and long-term creditors on the balance sheet. If we breach a bank loan covenant within the year, the full amount of that debt becomes shown in short-term creditors, which can lead us to a really significant net current liability position very, very quickly. So the key thing here is that if the breach relates to a post-year end period, then we don't have to do that, and it might only be a disclosure. But the key thing here is if we are going to breach our bank covenants before year end, the key thing is to talk to our banks early. And if we're in a position that we can get a waiver or a restructure done before the year end, then we won't have to present our debt as all due within 1 year, which is very, very useful for the presentation of our balance sheet. The last point is really that if we have a situation that occurs post-balance sheet event in relation to going concern, that will always be an adjusting post-balance sheet event for the financials, and it's commonly referred to as the breakup basis. So just to make that point, that's one small exception. 2 quick points to make on dividends. If the dividends have been approved by the directors but not paid before the year end, then they cannot be booked in the financial statements. So an alternative to that is for dividends to be approved by the shareholders. That creates a legally binding obligation, and therefore, albeit they may not be paid by year end, they can still be recorded in the financial statement. So a short kind of planning point there. Lastly, to talk about provisions, this is a very extensive area, and what we've really tried to do is to distill it down to 3 scenarios. If you have a situation, say, for example, a court case or we've been sued, if it's probable, i.e. greater than 50% that we will have to pay out, we need to provide and disclose that in the financial statements. If it's only possible, i.e. less than 50% likelihood that we'll have to pay out, then we disclose and we don't have to include any actual provisions in the accounts. And if there's a remote possibility of us having to settle the liability, then we do nothing. But 2 things to be mindful here is rent leases. So if we have a property leased, say we have an outlet that we're no longer using, we've discontinued, that could result in a situation that we have to make provision for the remaining rentals on the lease term. So potentially up to 5 years lease rentals could have to be accrued in one set of financial statements. So, very important there if that does become the case that, those properties are repurposed in some way that they provide benefit to the company. And finally, for our restructuring provisions, we can only include those in our accounts once we formally communicated to those affected by them, and there's specific rules with what costs can be provided for. So really, that whole section, post-balance sheet events and provisions, it will have a substantial impact on financial statements. But because everything is centered around and pivoted on the balance sheet date, it really does present us with an opportunity to manage them favorably now with a bit of proactive planning as we approach year ends. And just lastly, before I hand on to Keith, just a few final points there. So now presents us an opportunity to maybe restructure some of our existing arrangements, business operations from a risk management perspective. Merging companies could be an option to consider right now as we approach kind of year end. Indeed, certainly, a lot of groups would have companies that are no longer required, and these indeed could be tidied up by dissolving them. And really do be mindful of holding excess cash reserves and balance sheets as we approach year end, with banks proposing negative rates of interest and the need to preserve cash flows. It may not be a prudent measure to hold surplus cash within a trading entity. So with that, I'll pass over to Keith, who's going to talk to us about some of the financial statement disclosures that we need to be mindful of in the current climate.
Thanks very much, Dave. Good morning, everyone. I'm conscious of time, so we're on to our last section. So I'll get through what we're going to cover, being the disclosures around financial statements and getting the balance right. And that's particularly, you'll see a linkage between some of the areas that Dave has touched on. They flow through into the financials. As Donald would have mentioned earlier, there's a knock-on effect into our disclosures. And from there, we'll run into the, I suppose, requirement for preparation of financial statements and then what's publicly filed on the back of preparing and disclosing all the information. So we'll set out the minimum disclosures required by the standards in the Companies Act based on the size of the company. We'll focus mainly on small and medium, and we'll deal with the director's report and then some other disclosures. And while these might be the minimum disclosures required, it's also a point to note that there may be additional disclosures required to show in true fair view. And that's also true and fair view override disclosure. Now, that's more an exception than the norm than we'd see, but it's just to point it out. And then there's also voluntary disclosures that may be included should you or the directors wish to give the reader or the stakeholders a better understanding of the financial statements and what's contained in them. So some considerations then when we are looking at our financial statement disclosures would also include public company filings are a good barometer and a benchmark of best practice, what's out there within your particular industry. For example, if you're in the hotel industry and operation of hotels, the Delata Group would give you a good feel for the type of disclosures that may be put out in the public domain around that industry. Similarly, there's industry and sector specific guidance being issued by standard setters, oversight bodies and regulators, both here in the UK, and they could be of good guidance and good indication of the level of disclosure and level of detail that's required, again, based on your industry or your particular sector. We'd also feel it's very important to include positive developments. It's not all doom and gloom, hopefully, for everybody. And the development, for example, Dave touched on his example around online sales platforms and IPs, new business development opportunities that may have arisen, successful refinancing. And then it's also a great opportunity to thank, firstly, your in-house employees for their commitment and efforts over a challenging time, customers for their support and loyalty, and also suppliers who may have worked through a lot to help you keep you in business. So that's also hugely important. Then coming back to COVID-19, while we're still in the midst of it, there is an expectation there that oversight bodies and regulators will continue to expect to see disclosures around the financial statements. As we're in 2020, we would have finalised 2019 financial statements, and a lot of disclosures would have been, as Dave referred to earlier, post-balance sheet events. So we're now in 2020 and looking forward to the year 2020, what the disclosures might be. So moving on and looking at actual disclosures and trying to get the balance right, and we'll focus on the director's report initially, and looking at a medium-sized entity, what's required. Firstly, it's a business review, so it should be balanced and fair, and talking about the development and the performance of the business, both on the P&L performance point of view and also the assets and liabilities. And then also if there's any non-financial and operational developments that you want to disclose. Just to note, for large entities, there's a requirement to have KPIs for that particular company, disclose and analysis, both operational and then our financial and non-financial KPIs. Details of future developments of what there might be. Dave touched on earlier, principal risks and uncertainties, and again, they flow through into the financial statements and what those risks and uncertainties are, for example, around financial, liquidity, economic, operational, and then how the board, the directors, and the business has been positioned to mitigate those risks and uncertainty and give comfort on them. And then if there's any significant material events, post-balance sheet event that needs to be disclosed, that needs to form part of the director's report. From a small size company, obviously there's significantly less disclosure for the exemptions that are available. So the main point would be the disclosure around events since the balance sheet date. Additional disclosures can be included, I pointed out earlier, should the directors wish. Again, they may be a positive, just to give the reader a better understanding of the year. So it may entail a bit more than what would be required. So it's always good to bear in mind. The financial statements then themselves, and in particular around the notes, so both medium and small size companies will be required to disclose, as Dave touched earlier, if there is an uncertainty around the ability of the company to go on concern, that would need to be disclosed. A change from going concern to net reliable basis, so as Dave mentioned earlier, an ongoing concern basis, that would be, for an example, where there's a voluntary strike-off process happening around a company that's within a group, and because of a group restructure of operations, the company is no longer required. That would need disclosure. Details of the financial impact of material events post-year end, so the post-balance sheet events Dave touched on, again, they would form part of disclosure in the notes, and they would need to be consistent with what would be disclosed in the director's report. Judgments, again, Dave touched on a lot of areas, and you'll see there's a clear linkage between the challenging areas from a practical point of view and what flows into the financial statement. So there's disclosures required around the judgments applying the accounting policies, and areas are key source of uncertainty. So for example, valuation of properties, recoverability of debtors and amounts owing from related parties or intercompanies, revenue recognition or valuation of stock. And on the back of those, additional line items maybe need to be disclosed on the P&L, where the presentation is necessary to give an understanding of the financial statements and the results for the year to the end user. So, for example, if there's an impairment been recognised in the year, or on the flip side, if a valuation has been obtained and an asset been brought from cost to fair value, which would have a positive impact on the P&L, a separate line item on that, amount owing to or from group companies being forgiven or being impaired following the year that we've had. Again, they would need to be disclosed on the face of the P&L to give the reader a good feel and understanding of the results for the year. So again, we're conscious of the challenges that these disclosures, no different than the practicalities around a lot of those areas, would pose both boards and finance teams. So we're here to assist, and we can provide you with information, templates, advice in any of those that matters, or if there's any other areas not covered today, by all means get in touch. Moving on then in relation to the actual financial statement preparation and the final requirements. So again, from an audit perspective, a company needs to qualify as a small company or micro company initially to avail of audit exemption. So an audit may not always be required. So I've just included, again, I'm sure everybody's familiar enough with the criteria, but just again, a refresher. So there's 3 criteria: balance sheet total, 6 million, being gross assets, turnover, 12 million, and number of employees. So you must satisfy 2 of those criteria for the current and the preceding financial year. A late filing of an annual return means, irrespective of size, an audit is required to be carried out in the following 2 financial years. So not the current year you're filing, but the following 2. So that's important to note. And then there are companies within legislation that are not allowed to avail of audit exemption, again, irrespective of size. So I've just included some examples there just for reference purposes. Moving on, from a group perspective, there is a group audit exemption available. So that's where the group as a whole, which would include the parent and the subsidiary undertakings, again, satisfy those criteria, 2 of the 3 conditions for the group to claim audit exemption. So again, for those not familiar with it, it is important to note, and based on the reduction or increase of turnover, you may fall in or fall out of that limit. So other considerations, just to, I suppose, consider, is there a requisite for the business to have audit financial statements, supplier credit limits, banking covenants, and now or in the future, as Dave has mentioned, it's always important to make reference to them, or planning for a short-term exit. So while you might satisfy the criteria from a restructure or a disposal perspective in your succession planning, it may be advantageous to have the accounts audit. So there's some points just to take on board. And then as a result of the impact of the events we've seen in the current year, both negative and positive, I suppose, it may bring your company within the relevant criteria thresholds that I've just touched on, or it may breach them. So it's always good, as we touched on earlier, to plan for these events, and you'll be able to project out to the end of the year how you're going to look and see, does it have an impact on what you can or can't do around audit exemption. And then moving on, beg your pardon with it. Just around the filing of financial statements. And so it's a good time to take a step back and look and actually see, well, what actually gets filed in the company's office on the back of the financial statements being prepared. So companies that meet the small company criteria can claim an abridgment exemption. So what actually gets filed then on the back of that? So a medium-sized company, in essence, you're filing full financial statements with a special audit report, but in essence, it's your P&L, your balance sheet, full notes. From a small company perspective, you're filing full financial statements in summary without your P&L. So again, there's a full requirement for the notes that are included in your financials to be filed with the abridged financial statements. And there is an additional requirement for the movement on the P&L. While the P&L doesn't need to be disclosed in full, the movement needs to be clearly disclosed so that it's either by way of note or on the balance sheet. So it's also important to note out, again, on the back of the current year, whether the thresholds involved, whether going from small to medium or medium back to small, how's your company looking in relation to that? And does it have an impact on what's going to get filed? And that's something to note and plan for at this point in time, so that there's no surprises post-round for you. Unlimited company, there's no financial statements filed in respect of an unlimited company. The special audit report is all that gets filed. So I've included a link below. Once you get the slide deck, you'll see it'll provide a detailed link back to the CRO, which has good narrative and detail further around those areas. But by all means, if you have any questions around it, feel free to contact us. Be more than delighted to help you. So I'm just going to hand you back over now to Dave, who'll wrap up what we've covered.
Thanks a million, Keith. And just apologies, guys, we've run over a little bit, and so our apologies for that. But I think we summarized or tried to summarize in kind of the 4 succinct points there, some of the key takeaways from what we've covered this morning. The importance of the director's assessment of going concern. It's vital to protect our directors. Financial projections are the cornerstone of that assessment of going concern, but they're also very, very useful in terms of justifying the carrying value of our assets. And so, really that's going to be a hallmark of how we go into 2020 audits. It's all going to be around where we think we can project our businesses will be sometime down the road. Post-balance sheet events and provisions, very, very topical, but they can be managed is the key message there. And then finally, some of the final points we touched upon there were really, is now the time to consider potential restructuring operations to manage some of the risks we now face? Are there synergies and planning opportunities we can benefit from by looking at our current operations? And, finally, really, as Keith touched on there, it's a good time to consider what information in respect to 2020 will end up in the public domain and filed with the company's registration office, and whether there's scope to look at that and reduce this level of disclosure and to plan for that now. Look, again, we're here to help in any way we can, so please do get in contact with us. And with that, look, I thank everybody so much for their time and pass back to Donal.
That's great. Thank you, Dave, and thanks to Keith for that very comprehensive review of what's required for the year. I think the key issue there is to make sure that they're looked at as we go along so that accounts can be finalized as quickly as possible and allow other businesses decisions to be made on a timely basis. We are running over time a little bit, but we'll just go to Denise there and see has she got any questions for the speakers this morning.
Morning, everyone, and apologies for running over time. So I just have 1 or 2 quick questions here. The first one's to Shane. Has there been any difficulty in availing of the debt warehousing scheme in practice?
No, there hasn't really. We found the revenue have been very practical in their approach and how have worked with us. When we got towards the deadline at the 30th of September, the initial one that was in place, we found they were very responsive in coming back. So I think the key thing for all clients is that if they are looking at warehousing or if there is a problem in terms of payment, is to engage early with the revenue and make sure returns are still filed and that there is an agreement put in place with the revenue. That will keep tax clearance certs in place and won't cause any issues.
That's great. Thanks, Shane. And then one other question here for the guys from Audit. Are there any ways that companies can avoid having to file their financial statements?
Yeah, great question. Yeah, Keith touched on it during this presentation that certain types of companies, unlimited companies, certain types of those don't have to file their financial statements currently. But there are still possibilities to structure group companies in such a way that they do not have to file financial statements. So obviously one of the disadvantages of an unlimited company is that the liability is not limited. But in short answer, yeah, absolutely. There are still kind of some very pragmatic steps that can be taken to reduce completely, in some cases, the financial statements having to be filed publicly. So yeah, certainly something really worth considering and having a look at this time.
Okay, that's great. We might leave it there. I suppose we've taken enough of your time. I'd like to thank you all for today, and the slides will be sent out as well as a recording of the presentation at some stage later this afternoon. And a reminder as well, we launched our PKF app last week, so it's PKF OCLH on both Google Play and the Apple Store. So download that now, and lots of helpful assets there for you to use to make, I suppose, business life a little bit easier. So just pass quickly back over to Donal, I think, just to say goodbye, but thanks very much for your time today.
Great. Thank you, Denise. Thanks for organising the session today, and thanks to all our speakers for participating with some very valuable content. But most especially thanks to the audience for joining us this morning, and hopefully you'll be able to join us next week for our 3rd episode in our autumn webinar series. Thank you very much, and look forward to talking to you next week.